Welcome back. Today we are talking about gold and whether dividend investors like us should be adding it to our portfolios right now. Because here is the thing, gold has been absolutely on fire. We are talking about gold surging past $5,000 an ounce in 2026, and over the past 2 years it has nearly doubled the returns of the S&P 500. So if you have been sleeping on gold, the conversation has officially changed. But before you run out and buy a gold bar, let's talk about what this actually means for us as dividend investors, because gold and dividend investing have a complicated relationship. Here is the core tension. We build dividend portfolios because we want income. We want cash flow. We want companies that pay us just to hold their stock. Gold does none of that. Gold pays no dividend. Gold pays no interest. It just sits there. And your returns depend entirely on the price going up, which is not guaranteed. So why are we even talking about it? Because right now the economy is throwing a lot at us. Tariff uncertainty, questions about the strength of the US dollar, inflation that is still stickier than the Fed would like. And when those kinds of pressures build up, historically, gold moves in the opposite direction of the stock market. That means when your dividend stocks take a hit, gold can help cushion the blow. Think of it less like an investment and more like insurance for your portfolio. Now here is where it gets interesting for dividend investors specifically. If you want exposure to gold but you still want income, you do not have to buy gold directly. You can look at gold mining companies. Several of them actually pay dividends. And when gold prices rise, mining companies can see their profits go up significantly, sometimes double the move in gold itself. So you get the upside of rising gold prices, and you still get paid. So what does a smart allocation actually look like? Most financial analysts suggest keeping gold between 5 and 15% of your total portfolio. Not your whole portfolio, just a slice. Enough to protect you when things get rocky, but not so much that you are sacrificing the income and compounding power of your dividend stocks. Because let us be clear, over the long term, dividend stocks and equities still win. We are talking about nearly 7% real returns annually over 2 centuries for diversified stock portfolios versus less than 1% for gold. Gold is not a wealth builder. Gold is a wealth protector. So here is my take. If you are a dividend investor who is watching the news and feeling a little nervous about where this economy is headed, a small gold position makes sense right now. 5 to 10%. And if you want income on top of that protection, look at dividend-paying gold miners instead of just buying a gold ETF. You do not have to choose between protecting your portfolio and getting paid. With the right strategy, you can do both. As always, this is for educational purposes only, not personalized financial advice. I am not a financial advisor. Do your own research and consult a professional before making any investment decisions. If you found this helpful, share it with someone in your circle who is trying to figure out this market. And I will see you in the next one.